Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another live stream. Happy Easter. I scheduled this live stream before I remembered that it was Easter, but here we are. Money never sleeps. Got a great video for you today. Probably my favorite investing strategy, right? We love talking about the market trends and strategies and, stocks to buy right now on the channel. But one of the easiest and best ways to invest is in those unstoppable trends, okay? The trends, the long-term multi-year trends with trillions of dollars of force behind them that are going to lift all the stocks within their industry, right? So that means, if you're in one of these trends, if you're investing in some of the stocks that are going to benefit from these trends or in these sectors, you don't even have to worry quite so much about picking the best of the best stock, about, rolling the dice and getting that best stock in the list. You're going to benefit from those trends, and those trends are going to lift all the stocks in those trends while you're at it. So great way to invest. I want to welcome everybody that's in here already in the chat. See Ambrose there, Melanie, longtime members of the Bowtie Nation. Now I have locked the chat to members of the Bowtie Nation. I've left a link to the Members Center there in the chat. Check that out. Not only are you going to get access to the chat there, some of these private members only live streams that we've been doing a few of these. I'm aiming to do probably about 2 private members only live streams each month. Wanted to open this up to the overall community just because I love this investing strategy so much. I wanted to share it with everyone. But check through that. You're going to see all the custom perks and access you get with those memberships. It's only $4 a month. On the lowest level, you're going to get the loyalty badges, the custom emojis. You click through here, you're also going to get the free spreadsheet. You can get the spreadsheet for just that Bowtie investor level. That's worth $15 alone right there with the spreadsheet. And then with the insider, you get a lot of the extra notifications when I buy or sell stocks, real-time notifications for those. So just check out the link there in the chat or in the description below. Become a member there of the Bowtie Nation. I want to get started though. We're also going to have time for Q&A today. But, again, like I said, I love this idea of that long-term trend investing because it gives you that automatic leg up into choosing which stocks are really going to be the growth stocks over the next 5 or 10 years or so. And so one of the, the first one we're going to talk about here is electric vehicles. Okay. And, some of these trends aren't going to surprise you. We've talked about them on the channel before, but I'm going to show you why they're unstoppable. We've got a lot of these trends out there. The electrification, the ESG was a trend a few years ago. Solar has been a trend, but they've seemed to kind of fade away. Marijuana stocks were a trend for a long time, and they've seemed to just fade away and really don't have that unstoppable nature behind them. So I want to cover these 3 trends that we're going to look at, why they are unstoppable and why they will continue to really force money behind a lot of the stocks that we're going to talk about. So with electric vehicles, one thing you got to understand here is electric vehicles, for all the growth that that we see in them, and let me switch to the graphic here. For all the growth that we've seen in electric vehicles and the money that is behind stocks like Tesla and things, this is still only 7% of the total vehicle sales in the U.S. It's a little bit higher in China. It's higher in Europe by a little bit, but as of 2022, 2023, only 7% of total vehicle sales are electric vehicles. That is expected to be as much as 90% of the market by 2050. Really on why, a lot of the forces that I'm going to talk about next. But, so this is Morgan Stanley Wealth Management estimates for electric vehicle stocks to be as much as 90% by 2050. Now, by 2050, I'm going to be about 80 years old, so I'm not looking quite that far out. But even by 2030, even if it just goes up to this, 25% of vehicle sales by 2030, if we look at annual vehicle sales right now, about 15.5 million on a yearly basis. That gets up to about 17.5 million during good, bull markets, good economic times, right? Definitely not when interest rates have doubled over the past, for car loans have doubled over the past year. But in normal economic times, that gets up to about 17.5 million. It should rise, incrementally over the next 10 or 20 years. But even on that, so on just a 20%, 30% of that, of that 17.5 million annual car sales, that gets us to electric vehicle sales of about 3.5 million by 2030. Okay, that is less than 10 years. That is only 7 years away, and nearly 16 million in EV sales by 2050. And that's without assuming any growth on that 17.5 million cars produced or cars sold annually. Okay, so you've got those, that growth in store for electric vehicles. Right now, it's right around 1 million electric vehicles sold in the U.S. per year. It's about 7% of total vehicle sales, up to 3.5 times that much, 4 times that much, just in the next 7 years. Okay, and now I want to look at, why is this kind of an unstoppable trend? Okay, why is the electric vehicles going to continue to increase and reach those numbers? And really, it's because the government and car makers are pushing these so hard. We see here just a chart of some of the countries with internal combustion engine bans or electrification targets. You see the very light yellow ones are 100% electrified sales, and the dates on those. So the UK, one of the first here, 2030. The UK is aiming or targeting for 100% EV sales. China and Japan follow in 2035. The yellow here is 100% ZEV, zero net zero sales. Okay, so not quite 100% electrified sales, but just net zero emission sales, and that's pretty much all the rest of them. Okay, you've got most of Europe there. Norway by 2025, not sure they're going to reach that, but you've got a lot of these, Netherlands, Sweden, Ireland by 2030. You've got the United States in there. Yeah, Spain, Portugal, even the further ones, the net zero pledges here in 2045 and 2050. So you've got the governments really pushing for these net zero or electrified sales targets, and then you've got the automakers. The automakers are pushing behind these just as strong. You've got these electric vehicle sales targets and goals by Volkswagen, 50%. Volkswagen wants to do 50% of its sales in EV by 2030, okay? Or the EV sales in the U.S. by 2030, 70% in Europe and 50% in China. Mercedes-Benz aiming for that 50% EV target by 2025. You've got Stellantis, 40% of its sales in the U.S. By 2030. GM and Ford are both up there. So you've got, and you got to understand, these aren't just talking up the the popularity of EV. These companies are putting money behind these. They're putting R&D dollars behind developing those cars. They're putting money behind the marketing and really trying to hit these targets. The third, the third reason why this becomes an unstoppable force is because we are reaching that price parity with combustion engines. Okay, the batteries for electric vehicles are 35% of that total EV cost in most cars, and the recent trend in improvements looks like it could actually lower the price of an electric vehicle to about $18,000 by 2025. That's according to Morgan Stanley research, bringing the EV car prices down to parity, really, and even below some of those internal combustion engines. So you've got the not only the force of government regulations, government targets, the car makers as well as just the price parity. Consumers are going to vote with their wallets, and they're going to find those EV cars, the prices on them coming down. We've already seen that actually in really the price wars this year. Tesla just last week announced another price cut to its U.S. models that follows several prior cuts. Started in January. That was met by reactionary cuts by a lot of the other EV makers. Ford, GM, Rivian all cut the prices of their cars. Now, of course, that's something different from that price parity in production. The price cost for production of these EV vehicles is still well above what it costs to make an internal combustion engine for a lot of these companies, but they are getting there, right? And I think this price war that we're seeing this year, while it is going to hurt the stocks in the near term, okay, over the next few months, investors are really going to be worried about the profit margins on a lot of these EV car companies. Tesla, Rivian, NIO, not so much NIO because it's mostly China there, but also that, as well as Lucid Motors, really going to get hurt by this price war as investors worry about profitability and those margins. But I think that price war is going to force these companies even more than they are already trying to really lower the costs of production for those. So if we're really looking at that long-term trend in EV, then we want to start looking at those car companies or the other partners in this industry. Now, of course, you can go with the car makers. I actually just opened up position in Rivian about a month ago. I think, while Rivian is still unprofitable on its per car productions, I see Rivian really as where Tesla was about 3 or 4 years ago. If you remember right, Tesla was still ramping up. It was still unprofitable on every car it sold. But then it met that sweet spot in production where the costs really started coming down. And that's where it really took off, where profitability took off, and where the stock price really took off. And I think that's where Rivian is really close here. They've already committed to. They've had a target of 50,000 cars produced this year. That did come in under estimates earlier in the year when they released that. But then in a private memo to its staff and to manufacturing, then Rivian said it could meet that 67,000 cars produced this year. So I think management is just being ultra conservative with its sales target or with its production target of 50,000 this year. That would still be double what they produced last year. So they're going to double their production this year, almost definitely. Might even go a little bit higher than that and surprise the market. And again, I think they are just right before that sweet spot where they get to production costs really start coming down, getting and becoming more profitable. Of course, Tesla, you can't ignore Tesla if you're talking about stocks in the. I just realized I didn't have that on. So I had that on Rivian, ticker RIVN. Tesla, obviously the clear and runaway leader in the space. And I think Tesla is really playing its card here with this price war. Okay, Tesla is really the only car company that has that profitability in its production for electric vehicles. Production costs for all the other EV makers are well above what they're able to sell the cars for right now. So we are seeing it hurt a lot of the other car makers, especially Rivian, Lucid, the pure play car makers that aren't quite as far developed as Tesla. You're going to see Tesla benefit from that. Okay, they did just announce their quarterly sales last week. I think it was 36,000, or it was up 36% from the year before. Not quite the 50% growth we've seen in the past from Tesla on a year-over-year basis. It did kind of underwhelm the market, but it is still strong growth, and I think they're going to benefit from this price war because they can cut their costs quite a bit, or they can cut their prices quite a bit lower and still be profitable versus a lot of these other companies. The other parts of this market that I'm really looking at is, a lot of investors, they just want to look at Tesla, they just want to look at the car makers, but I think there's just as much and maybe more opportunity in a lot of these other industries within electric vehicles. Okay, you've got the battery minerals that are going to face a huge supply shortage over the next 5 years or so, especially lithium. Lithium is one of the ones that people talk about most. Of course, you can go with the lithium miners, the Albemarle Corporation here, ticker ALB. And I know Chad always gives me shit about mispronouncing that. I'm sure I did there now too. But it is really the U.S. Leader in that. You've also got Lithium Americas, ticker LAC. What I've been looking at and what's really interesting here is, we've got such a supply shortage of lithium, and the fact that China owns or produces the vast majority of lithium on the planet. There is a lot of R&D dollars going into finding a suitable replacement for lithium and a replacement for that battery technology in electric vehicles. One of them is actually graphene. Graphene battery technology could be really the future. And this is something you got to understand about some of these growth trends. Is you need to diversify your bets around different industries within these mega trends, right? Because while we have huge supply shortages for lithium and for that battery material, there's no guarantee that it might not be replaced as a source of for batteries. And that obviously if you're paying the kind of price to sales for something like Albemarle, which price to sales right now is, we can see that's down to 3 times price to sales. That's not terribly expensive for a growth stock kind of play. It was as high as 7.7 times last year on a price to sales basis, which is extremely expensive unless, of course, that growth continues because of that lithium shortage. But if we get something like get graphene technology that replaces that in batteries, then of course, all bets are off on those lithium producers. So what I'm looking at is this graphene battery technology right now being tested by this GMF. That's a Graphene Manufacturing Group Ltd. It is a penny stock there. It is over-the-counter stock there. It's going to be extremely volatile, but it's a $103 million company, so very small penny stock there. They're testing graphene as just it's highly conductive, high charging capability. They've been able to show that graphene aluminum batteries could be interchangeable with lithium batteries and up to 70 times faster charging and last 3 times longer, right? So, this kind of technology, I think, Toyota is also testing solid state batteries for its electric vehicles. So there is no guarantee that we are using lithium in 5 or 10 years for our EV batteries. So you need to be watching something like this, something like this Graphene Manufacturing Group, $103 million market cap. If it's able to prove this graphene battery technology and prove, what it says that it could be interchangeable with the lithium batteries, faster recharging, longer lasting. I mean, this could be easily if it's just up to $1 billion company, that's a 10x return right there. Up to, if we've got some of these other companies here, like Albemarle, ALB, that is a $22 billion company. If imagine if graphene manufacturing rose to $20 billion, that would be quite a return there. And I think a bet that maybe you want to make if you're investing in some of these stocks. And of course, you've got the chargers. So the other bottleneck really in electric vehicles is the charging network and the infrastructure that we're going to need for that charging network. If we've got, growing from 1 million EV car sales a year to 3.5 or 4 and into, 15 million cars sales each year, you're going to need that infrastructure for the charging network. We haven't quite seen the infrastructure bill, the money come through to the states. That is coming through this year and next into 2025. You're going to start seeing that money from the infrastructure bill that was signed last year. You're going to start seeing that flow through the states to build out their charging networks. And I think that's going to benefit a lot of the charging stocks like ChargePoint, like EVgo had huge increase or a huge return on its earnings recently. And I think you're going to continue to see that. So, within this EV framework, you want to kind of spread out your bets across maybe the battery technology, charging, and then in the car makers themselves. Next here, I want to look at really just automation and AI, artificial intelligence, right? And we're not even talking about this chat GPT or full artificial intelligence, right? But just simple automation. Okay, AI is creeping along there. We'll eventually get up to, but it's not really even intelligent yet. It's just kind of scraping the internet to come up with, with fun ways to say stuff that have already been said on the internet. It's just scraping the internet, so it's not really intelligent yet. But this trend to just automation, this simple automation and very base level artificial intelligence, it is something that is going to continue. It's going to continue to rise. And the one reason that's really making it unstoppable is just the shrinking workforce, right? That is causing wages to jump in all different industries, pushing companies into automation. We can look here, probably the best chart to see this is just the unemployment level to job openings. Okay, this is how many jobs are open for every person that's unemployed. And you can see here, this has, all the way back to just before 2002, just before the dot-com bust, right? Rose up to about three people unemployed for every job, all the way up to 7 in the, after the great financial crisis, but it has trended down all the way through there. And I think what this really shows is the retirement by the baby boomers. Okay. At one point there was 10,000 baby boomers eligible for retirement every single day. And a lot of those are just starting to retire now. Right now, here in April 2022, had reached a level here of just 0.43 people, unemployed people available for each job. Okay. So, invert that. So it makes sense there. 2 job openings for every 1 unemployed person. And it's just getting worse and worse each decade. The jobs market is the only tight market right now. With the economy slowing, the jobs market is still growing. But yeah, two job openings for every one unemployed, and it's not getting any better. We are still seeing massive retirements by baby boomers, as well as pre-retirements, even in the Gen X, even in my generation. Combine that with the fact that those robotics and the software behind the AI and the automation software is just becoming cheaper as they get really implemented into uncompetitive prices on those robotics, and the software is becoming so cheap that as it gets implemented into different industries, so as different industries, fast food, we're seeing right now huge push to use some of these automation and those robotics. Even in McDonald's has a hamburger flipper that's a robot, right? A lot of robotic processes there in fast food because they are managing such a labor shortage. As those robotics, as that automation software gets employed in different industries, that's going to push the entire industry to adopt that kind of a robotics and software, because anyone that doesn't adopt that kind of those robotics and the automation is just going to be uncompetitive. It's not going to have the kind of margins, profitability that are had by the companies that are embracing that software. So I think you're going to see a real inflection point, a real tipping point for a lot of industries, where once a certain number of companies have started using automation and robotics in the industry, then it just becomes an inflection point where all the companies have to start using that software or some iteration of robotics and automation just to stay competitive within that. So a couple of the stocks that we're looking at in that, I think UiPath is probably the best automation and and kind of AI, base level AI stuff we've got out there. That's ticker PATH. I've actually owned these shares as well as Rockwell Automation. Okay, another one you might want to look at. This is more of an industrial automation stock. So I think industrial use is probably the furthest along as far as robotics and automation, obviously, especially in the car industry. But they are really branching out, taking robotics and automation and that software out to other industries. And I think Rockwell is probably going to be one of the biggest beneficiaries at first of this trend, is really taking it and making other industries embrace this trend of automation. Here we are on the charts here. So that's Rockwell Automation, ticker ROK there, and UiPath, ticker PATH. The two stocks I'm really watching in automation and AI, that kind of thing. Now, of course, there's lots of other stocks there in that AI idea. They've really been bid up here over the last few months. Just an AI frenzy with investors. A lot of them still very expensive and still very much in the developmental phase of their products. So not quite looking at how artificial intelligence is going to change the world here yet. I'm just looking at the companies that have already got a product in automation, in software, in robotics that are already being deployed in those different industries. The third trend here, and then we'll get to some question and answer here, is copper. We've talked about that trend in copper and really the forces behind it as a mega trend here on the channel before. It's probably one of the biggest trends that nobody is talking about just yet. I've showed some copper or some charts here. The thing most people don't understand about copper is that it is such a good conductor of electricity that it is needed in this entire electrification trend that we're seeing, not just in cars, but in cities, mega cities, or cities changing to an electrified grid or an electrified process in a lot of stuff, the Internet of Things. So you've got green energy transition plus the long-term supply gap, right? Is what some are predicting. Goldman Sachs here is predicting $10,000 copper that would be per ton, and you got the chart on the left here. The demand by region. You've got between China and then the rest of the world. So ROW is going to be rest of world renewable demand, China renewable demand, US and EU. And you can see this really starts to go parabolic really here in 2024, 2025, really start building on those as, obviously we get to those targets and we get to those electrification goals and those, those net zero emission goals that a lot of these countries have made. Within probably the biggest story, obviously, is still electric vehicles. It takes 3 times, almost 4 times more copper in an electric vehicle than it does in a combustion engine car. Okay, so your normal internal combustion car uses about 50 pounds of copper. You've got a chart here by the Copper Development Association. Hybrid electric vehicles use about 85 pounds of copper. Plug-in hybrid vehicles, 132. You got battery electric vehicles, so those full electric vehicles, 183 pounds of copper, almost 4 times more copper than is used. Again, when we see that trend in electric vehicle sales, like we looked at earlier, up to about 3.5 million from just 1 million today by 2030, up to about 16 million by 2050. Obviously, if you think about 4 times more copper used in those electric vehicles compared to the internal combustion engines, how much more copper we need for that. From there, so we have that supply, or we have that demand there. From there, we can go to the supply charts, and this is by the International Energy Agency. So just some mine production and demand estimates for those for copper, lithium, and cobalt. So the main minerals there used in electric vehicles. We've seen, we see that lithium, but again, there's no guarantee that we might not be transitioning away from lithium as a resource for the batteries, which would, of course, destroy this whole the demand chart for this. But copper, there's no getting around that. Copper is such a good conductor of electricity, used in not only the cars but the infrastructure for electrification, or for lowering greenhouse emissions and construction. But if you look at this, so we've got the red bar is the demand curve for this. The dark blue here for copper is under construction, right, or operating supply. Okay, so total current planned supply for copper miners across the world. The light blue has under construction and other projects, so that's a little bit higher, if those projects ever come to fruition or what. But you can see, even with that under construction projects that ramp up in production that copper miners are planning right now, we are still at a supply deficit for copper within 2025, even late 2024, 2025 into 2026. It's really why you see Goldman Sachs, a lot of other analysts predicting some kind of a massive copper shortage and an increase in copper prices. Okay, we saw that Goldman price target upwards of 12,000. It's ranges from 10 to 12,000 over the next couple of years. That's per ton of copper. That would be obviously 2,000 pounds per ton. So you divide that by 2,000, you get the price per pound here. Where the futures trades. But if you've got, 12,000 tons, $12,000 per ton of copper, that's about $6. That is well above the $4 price range where copper trades right now. Goldman has even come out and said, by 2030, we could be seeing at least 15,000 pounds or $15,000 per ton of copper. That's about $7.50 per pound. So, just over the next few years, you're getting almost double, right? 750 divided by 4, we've got a 87% increase in the price of copper over the next 3 to 5 years there on that copper story. So it's something that you should definitely be watching there for the stocks in the copper theme there. I think I'm looking at Southern Copper, that's ticker SCCO, as well as Freeport-McMoRan, that's ticker FCX. Both of them miners, very large copper miners. Now, one thing that kind of worries me about copper miners, or two things really, is that one is kind of the politicization of copper resources around the world. A lot of the copper mines are in Latin America, in Mexico, Chile, Peru. So, as we get into that copper deficit, that supply shortage of copper over the next few years, are these resources, are these assets going to be, obviously the state is going to want a larger share of that profit, windfall profits from that, eventually even maybe nationalization. So that kind of worries me. That's the reason why I'm looking at a lot of these companies that have more domestic resources there in copper, like Freeport-McMoRan, like Southern Copper, a lot more assets there in Nevada and in the U.S., maybe even in Australia as well for copper resources. So that's really the major trends that I'm watching. I want to turn it over to questions right now. If you've got a question, go ahead and ask it in the chat there. Again, just my favorite way to invest, looking at these, these long-term trends, because you can be wrong from one day to the next on the direction of the market, specific stocks you like. But if you can find any of these mega trends with the trillions of dollars of force behind them and the unstoppable nature, as like we talked about in these, there is nothing that's going to stop copper growth in demand for copper, and we just don't have the supply of it. Okay, so that's going to push those prices higher, and it's going to benefit all the companies within that space. Electric vehicles, where you've got the combined force of governments and the car makers themselves pushing these out. You've got price parity with internal combustion engines coming very soon. That's going to bring the consumers in mass into that idea, and there is nothing that's going to stop electric vehicles sales from increasing. Right. So if you find these mega trends, you can invest in pretty much any company within that trend, and you're going to be making good returns. Okay, as opposed to you see some of these other growth trends, these other trends maybe in solar, in cannabis stocks. Okay, they are growth trends. There is a potential there, but you just don't have that unstoppable nature coming from all sides for those stocks. So you can make some money in those trends, but you have to have the best of the best stock. You have to be able to find the best stocks within those trends and kind of avoid the ones that are just going to go nowhere for years. What I'm saying in these mega trends, though, you can invest in pretty much any stock within those, and you're still probably going to do pretty well. So I want to scroll through the chat, see what questions, comments we have. I see a lot of members of the Bowtie Nation there. Thank you for being here. Ambrose, Melanie, Ivan, good to see you there. It's been a long while. How you doing, man? Steve, D-Mac. So Ivan wants to know, hope you're doing well. Been a while. Could we hear some general news about the market? Which sectors are good for investing? What about news about Bitcoin? Okay, yeah, sure. Actually, just finished recording my video for tomorrow, the market update video, Monday mornings, 9 a.m. And really, there's a couple of things I'm looking at. Okay, so one, probably the biggest question on investors' minds is, how is the market so strong right now, up towards a 3-month high, really at 4105 on the S&P 500? How is that possible when the economy is looking so weak? And if you look at, old economists like myself, if you're looking at economic data, you see how weak it is. We had the ISM services and manufacturing PMI data out last week. Both of them showed a slowing economy. The manufacturing data actually came in surprisingly weak, about 46 on that scale. Anything under 50 is recessionary, is a decline. So manufacturing manufacturing in the U.S. is definitely in a recession. Services surprised on the low side as well. Only about 50, I think it was about 51. Okay. Expected more like 52, 52.5 was expectations by economists. So that came in weak, came on just on the edge of growth there. We saw the jobs numbers on Friday, 236,000, right around where it was expected, but a far cry from the 500,000 jobs we were adding every single month, here towards the end of last year. So we are definitely seeing the market slow down. That regional bank crisis, I think, is going to make this far worse than anybody expects. If you look at regional banks are by far the leaders in lending as far as commercial real estate, auto loans, consumer loans, a lot of those loans that go out, small business loans, the vast majority of that is done by these regional banks. And they just don't have the confidence right now in their deposits. Okay, regional banks don't know how much deposits they're going to have on hand at any day to the next to be able to make those loans. So we are seeing a very, very much tightening in that loan officer survey that we see, very much tightening credit standards by these banks. I think that's very quickly going to flow through to the rest of the economy. We are going to start seeing Q1 earnings start coming out this week. The banks are going to start us off on Friday, so we'll see, bank earnings We'll see the rest of the earnings there over the next month. We're going to see Q2 earnings. So just for the Q1, analysts are right now expecting a 6% drop in corporate earnings for companies in the S&P 500. Okay, that follows a 4% drop in the fourth quarter of last year, and they're also expecting a drop in earnings on a year-over-year basis for the second quarter. So that's going to be 3 quarters straight of declining earnings for companies in the S&P 500. That is an earnings recession. I think the general overall economy follows it pretty harshly over the next couple of months into a recession. So why is the stock market so strong? Well, for that, all you have to do is look at the Fed and look at interest rates, something we're talking about tomorrow on the market update. But if we look here at the Fed Watch tool, so something I want to show you how to do. You type in Fed Watch, CME Fed Watch tool here in Google. It's going to take you right to it. This is by the CME Group, and this is based on what they do here. They take the changes in the Fed rates, the 30-day Fed futures pricing. So futures pricing on the Fed funds rate, they take that and create a market expectation of what the Fed is going to do with its interest rates over the next meetings. And I want to change my picture here so I can show you. Okay, so there we go. So we moved the picture there so we can see the whole chart. And if you look over the top here, you got the meeting dates of the Fed, right? All through this year, through the next year. We got the next Fed meeting here on May 3rd. That's going to, and then the market odds, the expectations of what the Fed funds rate will be after that meeting. Okay, current target range up here, you see this at 4.75 or 475 to 500. That's in basis points, so it's about 4.75 to 5% current target range on Fed funds. And the market is right now expecting 70% chance that the Fed raises interest rates one more time, 0.25% increase on Fed on May 20th or May 3rd when the Fed meets again. Just a 30% chance there that they keep rates on hold right now. But if you look at how that's changed, they give you this the estimates now, 1 day, 1 week, and 1 month ago. If you look at how this has changed just in the last month, as of March 9th, so a month ago, there was actually a 30% chance that the Fed funds rate would be as high as 5.75%. That is 0.75% higher than where it is right now. There was 50-50 shot, 56% that it would be as high as 5.5%, so 5.5%. So these expectations for Fed rate increases, obviously on that banking crisis, have come down drastically. If you see here, you look out here to the end of the year. If you look out here to the end of the year, now remember, current target for Fed funds rate is 5%, 4.75 to 5%. And if you look here, by December, the market right now is expecting that rate to be down to 4.5%, 4.25% to 4.5% by the end of the year. That would be down from the 5.25% that it expects at this next meeting. So what that's telling us is right now, because the economy is so weak right now, because of that banking crisis and how it's going to affect the economy, the market is expecting the Fed to be able to lower interest rates 3 times, or 7.75%, 75 basis points by the end of the year. That is a huge, it would be a huge pivot for the Fed. It would be a monstrous support of the economy and of the market if it's able to get there. Now, of course, this is all going to depend on if inflation comes down fast enough to give the Fed, some pause in its rate hikes, and then to eventually start cutting rates. I'm not sure that inflation is going to come down fast enough to be able to allow that. A lot of Fed members, we got actually 6 Fed members speaking this week to the markets, and a lot of them lately have been saying, hey, the market is mispricing how many Fed rate cuts we're going to get this year. The Fed cannot afford to lose its credibility by cutting rates before inflation has come down to its target. So I think the market is going to be disappointed in that. It's why the market is supported right now at 4,100 on that S&P 500, because the market just expects the Fed to come to the rescue, cut interest rates, and really prop up the economy and prop up growth. So kind of depends on where you're at in that kind of line of thinking. If you think that inflation will come down quickly, if you think the Fed will come to the rescue and cut interest rates, or whether you think there's going to be a letdown, disappointment in the markets. That's going to guide you to what sectors you're looking at. Now, I will say, for kind of a short-term play, I am looking at some of the regional banks, specifically one regional bank that we've been talked about a little bit on the channel, FRBK. This is First Republic. Oh, see if I can get it in there. FRBK. This is Republic First Bancorp. Okay, not to be confused with First Republic, and that's why this stock is down so much. This stock, obviously, it's a regional bank out of Philadelphia, $82 million market cap, so very small regional bank, and just got destroyed during that bank crisis. Obviously, yes, because it's a regional bank, but also because a lot of investors have been confusing it with First Republic Bank, ticker FRC. Okay. A lot of traders, a lot of investors selling out of this, even shorting the stock because they get it confused with that San Francisco-based FRC when they couldn't be more different, these two banks. So I did pick up shares of Republic First right about $1.31 per share. Again, these couldn't be more different as far as banks. FRC, that First Republic, is based out of San Francisco. It's much more the venture capital, the startup tech industry, just like SVB was. It had to be bailed out. It's gotten like $30 billion in deposits from a lot of the larger banks, JP Morgan, just to try to salvage it, to rescue it. This Republic First Bancorp, FRBK, is a Philadelphia-based. It's much more that traditional commercial and consumer lender bank. I think they're obviously much stronger financial position than one like First Republic. So I am looking at opportunities in the regional banks. I do think, because we did see, we heard First Republic, that FRC did suspend the dividends on its preferred shares last week, I think on Friday. That's about a month after suspending the dividends on its common stock. So, FRC definitely is not out of the woods. I think that's going to weigh on sentiment for regional banks, at least during this first part of the week. Later on in the week, we do get earnings from the larger banks, JP Morgan, Wells Fargo, Bank of America. I think they're actually going to be showing some good, strong deposit growth and benefit from the exodus out of regional banks. So I think, the first part of the week, you probably see some weakness in the banking industry, in the banking area, especially the regional banks, but may turn to strength later on in the week as we see that, it's not across all the banks there either. I think, if you're looking at other sectors, I do think that the rally in some of these, tech stocks, as well as social media stocks and internet stocks, have kind of gone a little bit too far. Okay, yes, we are hoping that the Fed supports the market with the rate cuts later this year, but we are just getting into the recession, and I think it's going to surprise a lot of people really by the extent of how bad it is. So I think you look to maybe some of the safety sectors for now: utilities, consumer staples. You look for maybe even gold, and safety and cash. I've still got about 15% of my money, of my portfolio, in cash-like investments with CDs, treasury ladders that we talked about a couple of weeks ago, as well as those I bonds, still earning a very good return in I bonds, and protecting yourself from what could be a pretty tough couple of quarters to go. What else? If you were talking about, I know you asked about Bitcoin as well. Bitcoin's a tough one because, it has come up so far, so fast. I think a lot of traders are kind of looking at the SEC's case against GBTC and that ETF or trying to convert GBTC into an ETF, hoping that comes down on the side of Bitcoin. I know a lot of those large companies taking their money, their deposits out of the regional banks. That has benefited Bitcoin as well as Ethereum as kind of a store of value, as kind of a safety deposit for a lot of those companies. So that's why we saw that surge during the banking crisis up to 28,000 for Bitcoin. But it seems like it's a little topped out right now, right? So If we do get a sell-off in stocks, do get a deeper recession, I would expect Bitcoin to come down a little bit. I would be looking back at it. If it came down to 20,000, 22,000, somewhere around there, I might, look back on Bitcoin for a longer term hold, because I do think, it can get back up to 60s, 80,000, 100,000 here over the longer term as you get more adoption in there. What other questions? What are your thoughts on REITs? Do you have a top 3 list? Yeah, sure. So Steve wants to know about real estate investment trusts. It's been a tough sector over the past year, and even more so for some of the healthcare REITs that I look at. I want to look at the NAREIT. So I want to change this over here just to show you how I'm finding this. So if you go into Google and type in, NAREIT property sector returns or NAREIT sector returns, you're going to find this performance by property sector or subsector by the NAREIT. This is the National Association of REITs. Great resource here to kind of look at real estate investment trusts, the returns on those. So we'll get that, see if we can increase the size here a little bit. Okay, so what we're going to do, and I'm going to move myself over again here. Okay, transition there. Okay, so here we see the investment performance by property sector and subsector here for real estate. And again, you see 2022. Real estate in general, REITs in general, down 25%. Of course, this is because of that increase in interest rates, fastest interest rate increase in 40 years, and just the leveraged nature of real estate. Okay, so these companies, these REITs, are now paying so much more leverage or so much more interest expense on the real estate when they go to refinance those loans and buy more property. So you've got down 25% last year. Year to date, it's only up 1.74%. March was a tough year, or a tough month for a lot of these sectors. Office property down 15%. Healthcare down 5.25% last month alone. And so you start seeing some of these, you start kind of thinking about the longer term trends in these. I would not touch office with a 10-foot pole right now. Okay. I just read an article. It was either in the Wall Street Journal or on Bloomberg about really the losses in office property, office buildings. A lot of office owners are just letting those properties go back to the bank. If you don't know, a lot of office investors and owners, they have each office building under a different LLC, a different limited liability company, right? So if the vacancy gets too high on that specific building, if area dynamics gets too negative on that specific building, they can just let it go back to the bank or to whoever owns the mortgage-backed securities on those properties, and it doesn't affect the credit rating or the loans on all their other properties, right? Because each one is in a separate LLC. So we are seeing massive defaults on commercial property, on office commercial property. There's upwards of 30% vacancy in even Class A office property across some of the biggest cities in Houston, in San Francisco, in New York. That is huge vacancy. It's only getting worse as obviously the revaluation goes through. A lot of these, since these are on longer term leases, then it takes longer for the property values to adjust to obviously the pandemic and obviously people working from home and not going back to the office, right? So I think you've got at least probably another year here of falling property values for office, and you start seeing these office properties come down even more. So, eventually, obviously, the valuations are going to get just too low to ignore and too cheap to ignore for office property. You got things like Blackstone. I know they have an office REIT. Some of the other office REITs. Boston Properties is another office REIT. So I'd watch them. It's going to be at least probably another 6 months to a year before I think I would start looking at these. They are paying a 6.4% dividend right now, which is a very strong dividend yield. Doesn't want to highlight that. Very strong dividend yield, but I think the prices are still going down on that, and they still got a long way to go. Eventually, of course, like I said, the prices get too cheap to ignore, and they start revamping a lot of this office space, turning it into maybe condos or something else, or just not building quite as much. So you'll start looking at that. Medical properties, healthcare REITs, obviously, something we've been watching here over the past year or so. I've got a position in MPW Medical Properties Trust. I know I've been watching Sabre Healthcare, Omega Healthcare as well. All of those going down quite a bit here over the last year, really because the reimbursement rates from Medicare, from the government for a lot of these procedures hasn't kept up with inflation. Okay, so a lot of office providers, or healthcare providers, hospitals, things like that, they're having solvency issues. Okay, that is hitting a lot of these medical properties or a lot of these healthcare properties because obviously, as the owner of those properties, they depend on their tenants, their tenants to pay the bills and to pay that rent. So that's hitting them. The difference though I see between healthcare and some of these other hard hit ones like regional malls. Okay, you can see regional malls was down 23% last year, now offering a 6.4% dividend yield, very attractive yield. But what are the longer term dynamics for regional malls, for office space? Not good. Okay, I would not want to stake my bet on on those with the rise of e-commerce, with the work from home evolution. So you look at some of the attractive yields in here. And you've got healthcare paying 5.5%. Those healthcare properties, there is only going to be more demand for healthcare services. So even though we are in a very limited time, a very weak time for healthcare properties right now, I think it's an opportunity to pick these up because you will have the demand in the future, for those properties. I think, some of these other ones you look at infrastructure, you look at data centers falling 28% last year. Obviously that was from, big returns of the years before that for data center properties, but I think those are now down to more attractive valuation levels. You've got data centers like DLR, Digital Realty Trust, is a stock I own, REIT I own. Owning those data centers, which again are only going to see stronger demand into the future. You've got self-storage down 27% this last year. It's still a little bit expensive. I think, self-storage had huge returns the couple years before that, basically doubling or tripling in price for a lot of those self-storage REITs, but I think that's getting to a little bit more attractive. The lodging and resorts obviously doing better, outperforming the rest of the market, just because of that revenge spending by U.S. Spenders after the pandemic. So that's really what I'm looking for as far as REITs. Again, I would be looking at healthcare REITs, very attractive right there. Lodging and resorts are good, as well as data centers, data center REITs as well. Let's go here into the questions, see if we got, so it's a good idea to, what else? REITs. So Ivan says, so it's a good idea to invest in these mega trends now, Encore Wire, copper. Yeah. So Ivan wants to know, so is it a good idea to invest in these mega trends now? And it definitely is. I think, despite my feeling that we do see weakness in the stock market, in that rally over the next couple of months as a recession builds, the beauty of these mega trends is that, they are unstoppable and they are multi-year trends. Okay, so I think, I am especially this year, building a position into those electric vehicle stocks, especially Rivian, as that price war really weighs on the stocks. I think we do see lower prices in those electric vehicle stocks, even Tesla, which will benefit, undeniably will benefit from that price war in electric vehicles. But we're going to see lower prices, I think, on those stocks as that war intensifies, really, and investors worry about the margins on those and the profitability on those stocks, right? I'm using it as an opportunity to build up a larger position in those, because we do have that longer term idea. Eventually that price war is going to run off. Tesla is going to get tired of lowering the prices of its cars. Those other car makers are going to get better at their efficiency and lower the cost of production. And again, I think this price war is going to force them to do that even more, is force them to think even more about efficiency and cost of production rather than growth so much. But you do have that unstoppable nature of this, and it's a multi-year trend, 2030, 2050. So I definitely think you can confidently start investing in these mega trends now, even if you think, over the next 6 months, stocks are going to be, marginally weaker, because in the long run, you're still going to do very well. Okay, DMAC wants to know, is an EV ETF a better investment than an individual EV stock? You could have one ETF, I think, within each of these. Within the copper play, you've got the COPX, which is a copper miners trust. Within the EV, you've got other EV stock trends. I'm not sure what the ETF is there for that electric vehicle car makers. But I would much rather pick one winner out of there that I think has the best growth prospects. Again, though, you might want to just go with one ETF, maybe a third of your money for that mega trend, a third of your money in the ETF, just to get that broad support, and then pick a few of the stocks in that, right? Because again, I think when I look at Rivian, I see Tesla where it was 3 or 4 years ago, just before that big growth in production. They're doubling their production this year, probably a little bit even more. They're going to double production again next year, and at a point they're going to bring that profitability down to where they will really start to see the payoff and the profits like we saw in Tesla a few years ago. So I do like Rivian. Compared it to Lucid and some of the other car makers about a month ago in a video. Lucid very much more expensive than Rivian there as far as those smaller startup car makers. And I think with that growth in electric vehicles, I think you see plenty of demand for a lot of these companies to survive. So I'm much more, focused on individual companies within each of these megatrends. But, those ETFs, it's hard to go wrong with the ETFs because, again, they're going to give you exposure to the entire market there. What else we have? Ambrose says he added more to his MPW holding. Yeah, we've talked about Medical Properties Trust. Obviously painful to see the stock fall as much as it has been over the past year or so, and especially here over the past few months. It's really on weakness at its two largest customers, right? Steward being the largest customer or the largest tenant that they have. But I think, we're at the tail end of that. Steward has actually agreed to sell 5 of its Utah hospitals here to Common Spirit. Now, it does look like that MPW might have to take a hit on $300 million of that lease that it had to Steward, in that change, because basically what happened is they're selling the properties, or they're selling the selling the lease to Common Spirit from Stewart. Stewart's going to use that money to pay back a loan by MPW. So obviously that's going to improve the financial health of MPW. But the book value on MPW's balance sheet for that lease from Stewart was $1.2 billion, right? The book value changes to just $900 million, when that transaction is made. And I believe Common Spirit isn't going to be using MPW as it's managing the properties. So you got a change in book value for the leases, the tenant, the agreements there changing hands. So you got a $300 million write-off, basically, is what Wall Street Journal anyway is saying that is likely going to be coming for MPW. You had that news here on Friday. So we'll see how that affects the stock. But again, MPW management has already guided to $1.60. I want to say $1.60 in funds from operations. That very much covers the $1.16 in dividends right now. I know it's like a 14.5% dividend yield, which is really, unsustainable on the face of it. No REIT, no real estate investment trust should be paying 14.5% dividend yield. It's just not going to happen. But in times when the stock has fallen so much, and you look at the dividend sustainability in that funds from operation and the growth there, then I think it is sustainable. They've actually made some sales recently that should support that dividend sustainability in the short term. But my thinking on MPW and looking at maybe a potential dividend cut is, even if it is cut, okay, even if it's cut to half of funds from operations, right? So say MPW comes out, says, we're sorry, we tried to avoid it, but we're going to have to cut the dividend down to 80 cents a share, right? That would be half of the $1.60 in funds from operations. Management is forecasting for this year very much sustainable, 50%, coverage, or 1.5 coverage, or no, twice, two times coverage ratio for FFO is great for a REIT. Even if they did that, though, I mean, you would still be at like what, 10%. You'd still be at about 10%, double digit dividend yield on that stock. Even if you bought in, I think my cost basis right now is about $12 on MPW. If they did cut that dividend, that would still be a 6.7% dividend yield, which is still very strong for a real estate investment trust. And I think once we get over this short-term weakness in healthcare properties and real estate in general, as we've seen with with that NAREIT data, once we get over that, you've got some great price appreciation in these properties. Okay, so I think these are going to be one of the first to benefit as the Fed starts cutting rates. As we saw last year when the Fed was increasing rates, real estate got hit hard. It was the first or second worst performing sector last year. I think you're going to see it bounce back very quickly as the Fed starts lowering rates. And again, the market is expecting that to happen later on this year. So I would definitely be looking at I am looking at MPW. What else we got? What other questions? I'm going to scroll up here to make sure I didn't forget any or didn't see any. So if you got any other questions there, and I think all this talk about when the market will bottom is part of the video that I did tomorrow for the market update. I am expecting the market to bottom here within the next 3 months. We've seen that there in my son's alarm is going off. We've seen that really in the expectations for the Fed interest rates and how it supports the market. It might be splitting hairs for a lot of long-term investors. If you've got a time horizon more than 10 years, you're already getting about a 15% discount on stocks. Okay, stocks in the S&P 500 down at 4,100 on the S&P 500 index, now down about 15% still from that 4,800 peak of January of last year. That's still a very decent discount, right? So even if you assume $210 in earnings per share for S&P 500 companies this year, regular 7.5%, 8% growth over the next 5 years, that gets us to about $310 in earnings for the S&P, and 21 times price to earnings in a bull market valuation. That's still about 6,200, 6,100 on the S&P 500, which is a 58% return. So, I don't want you to think that, you have to time the market exactly right or you have to be too cautious with your money. Okay. Even investing now, I still think that's about a 9.7% annualized return on stocks over the next 5 years, which is still a very healthy return. So, if you don't want the risk of trying to time the market or holding too much cash back, you can always just, invest in stocks right now and not worry about holding very much cash at all. But again, these megatrends are really the best way to play it because, you're going to have those forces, those trillion-dollar forces behind the entire industry of those megatrends to really boost those stocks. So I want to thank everybody for being here. It's kind of a special Easter live stream. Want to try doing more of these. I'm going to do at least 1 or 2 special members only live streams here each month. So make sure you click through the link there in the chat or in the description below. Check out those member bonuses and perks and special access, and be sure to get in on those.